All right. Tomorrow we are getting the PPI data, and then on Wednesday we're getting the CPI data, and I do believe both of those reports will be very important on what the bond market's going to do. So very quickly, I want to start out with TLT. We talked about this during the weekend video when I was showing the bond market and how the bonds were going to play into how this year would play out, because we currently do have a bear trend and even a bear market in the long-term 20-year treasury here. And when bonds are going lower, that typically means there's no recession, because if the market was worried about a recession, bonds would be doing very well right now. So more than likely the bonds are down because they're worried about inflation. So with the PPI data and the CPI data, I do believe all of the bad news is completely priced in, and that's why TLT is down here in the dumpsters. And if the CPI and the PPI come in and they're anywhere near what is expected or cooler than expected, I do think you're going to see a very strong rally in the bond market. So this could be a low risk trade idea, but also pay attention to it for other reasons as well, like simply tracking where the money is going in the year 2025. And I talked about all of the areas money could go, like money markets, real estate, equities like stocks, and of course the bond market. So this will be a very important theme. We'll likely continue to cover TLT as the weeks progress, because I do think it's very important to understand the bond market this year, especially if we are getting risk of inflation, and then that could lead into more risk of recession. No matter how it plays out, the bond market will be a very important indicator, and it will also tell us where money is going or where money is leaving. And right now you can clearly see that money has been leaving the bond market, and that could be changing as soon as tomorrow or Wednesday with the data releases, especially if the inflation comes in better than expected. So watch TLT right around 85. I do think there's a chance it could rally all the way towards 90. And if you want to buy the dip here because you don't mind catching this falling knife, you would be buying all the way down towards 84. Now let's jump over to the S&P 500, and we're looking at the SPY ETF. And I talked about this in great detail about how I think a bear trap is being set up. And the first thing you can tell from the bond market prediction is that I think we're going to get a rally there. If the bond market starts to rally, that means yields will come down because it is inversely related. If people are buying bonds, the bond yields will go down as the bonds rally higher, and that will also take pressure off of equities that are rate sensitive. And overall, I just think we're going to see a very nice rally as we head into the end of the month, and I do think this rally could even last into the middle of February. So as you can tell from this arrow, I am looking to buy the dip anywhere between SPY 570s. It was right around 573 to 576. We did fill that gap today, and from here you have a very low risk entry because I have the reward going all the way up into the 600s. Now I could be wrong about this, so don't think I have to be right. I've been wrong before and I'll be wrong again. Trading is not about being right 100% of the time. It is about getting in the best risk reward trades with the best probability. And over time, if you continue to do that with discipline and patience, you will be profitable because your winners will be larger than your losers. If this trade loses, I will be completely fine. I will take my small losses and I will get ready for the next best trade. And it is really just that simple. If you find yourself panicking or freaking out or getting too emotional, it's because you either have way too much leverage or you went in too big of a position size. And as I always teach, I do not believe any of you should be trading options. Stick to shares. If you can prove you're profitable with shares and you still want to trade options, then and only then go messing around in that field. But if you stick with shares, time is on your side, and it really allows you to have that patience and discipline that you need to be profitable. So on SPY, I'm watching right around 573. The next bull breakout will be getting back above 584, and then we need to break this downtrend of lower highs and lower lows. But remember, by the time we get the confirmation that we're breaking the downtrend, we're going to be all the way up here above 598. And then if you wait to enter up there, you are taking on a lot more risk. I like the low risk entry where I know right away if I'm wrong, which is going to be the breakdown below 573. And we're also getting very oversold and overextended to the downside. So I do believe this was a great low risk entry. And as you know from all of my updates, I do believe this is going to end up being a bear trap, which means this is not going to turn into a downtrend. It's going to reverse and go higher. What a bull trap would look like is a lower high rejection and then just continue to flush down lower. And that means the bulls would be the ones getting trapped and not the bears. It is possible to continue lower, but I want to see proof in price, and I want to see another lower high rejection after we get a bounce and continue a little bit higher here. So we'll follow it day by day and we'll move like water. Always manage risk. So make sure for every trade you have, you know exactly how much money you're risking and where the reward is. And make sure your reward is at least 1.5 the times of your risk so that you can remain a profitable trader. On the NASDAQ 100 triple Qs, we also look like we're getting the bear trap setup, which is going to be a bounce right off of this support right around 501. And from here, I would be looking for a rally higher towards 538 and then 546. If we break down, we are going to go a bit lower to fill a gap at 493, and then from there we will be looking for the rally. So if we break down below 501, we're looking for a gap fill just below 493. If we continue lower or we get a lower high rejection and another lower low breakdown, then obviously the risk is increasing that we're going into a downtrend. I still think there's a very good chance this is just a pullback within a bull trend, and the rally will start after we get the inflation data. And then very quickly, a lot of you have been asking about Bitcoin. I do usually look at Bitcoin, but this has been a very common pattern we've been observing, which is this head and shoulders pattern. And if we break down below the neckline at 92,000, there's a very good chance we're going to go at least down towards 84,000 or about 80,000. But today we did bounce off of the support trend line, which was right here at 89,000. So the bears really want to see a break of 92,000 and then 89,000. But be aware of this head and shoulders pattern on Bitcoin, because obviously if we break down below the neckline, lots of bulls will exit. And I do believe you'll get a lot of bears that are trying to short this thing to lower prices. And if the panic kicks in and we get a liquidation of over leveraged longs, you could see a quick flash crash in Bitcoin. So manage risk there. It's possible this is also going to be a bear trap, which would mean a false breakdown below 92,000 and then a rally to a brand new all-time high. So don't forget, you can get access to the exact percent allocations that I am trading for the TQQQ and the SQQQ, and that is the TSC trade alerts, which you can find out how to join in the comments of this video as well as the description. So tomorrow we'll get the PPI data and we'll see where the market wants to go from there, and we will react accordingly. So be patient, be disciplined, and make sure you're managing that risk. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.